Let's now talk about a different type of derivatives contract, futures and forward contracts. Forwards and futures, they are very similar. They are contracts between two sides to buy, one side to buy, and that's called the long position, and the other side to sell, and that's called the short position, an underlying asset at a specified future date, which we call the maturity date, at a specified price, which we call the forward or futures price. Okay, so there are two sides to this contract. One side is buying something and the other side is selling that thing at a certain fixed point in time in the future. So there's a specific date when this transaction will take place, and there's a specific price at which that transaction will take place. So this is as opposed to normal transactions we are familiar with in our daily lives, which are called spot transactions or cash transactions, which is today we buy and sell, we engage in a transaction at today's price. This is an agreement to do this at some point in the future at some specified future price. Okay. Now, the difference between forwards and futures is forwards are highly customized, and these are private agreements between two parties, right? So two parties, maybe a company and a bank, or two companies, or an institution with another institution, decide to draw up a contract that they will do a transaction at a future date at a fixed price, and they can just customize it however way they want. So exactly what the underlying will be, exact characteristics, attributes, all that, highly customizable between two parties. So those are forwards. Futures are much more standardized with respect to those maturity dates, with respect to forward and futures prices, with respect to the quality and the exact specific type of the underlying. And these are traded through organized exchanges. And a big advantage of futures will be the exchange will be between the two sides as a clearing party. And therefore, you will not have a counterparty risk in the sense that both the long position and the short position will not have to worry about whether the other party can fulfill their obligation, because if the other party cannot, the clearing agent, the exchange, will step in and make sure the contract is honored. So these futures will be much more standardized and will not have this counterparty risk, which is a big advantage. But otherwise, these two type of contracts are very similar. Now, a big difference from options that we talked about before. Remember, options were rights but not obligations. And forwards and futures are obligations. The transaction will have to take place at that date, at that price. There's no getting out of it. So these are not rights, these are obligations, and the contract must be honored. It's legally binding. Whatever happens to the price of the underlying in the meantime is not going to matter. The transaction will take place. So that's a big difference. Okay. And another important difference with options is, remember, options had a value. That option contract that gives you the right but not an obligation has a value. So this is something you pay for and you can sell. Whereas these forwards and futures, the negotiation will be on with regards to what the forwards and futures price will be. Once the two sides agree, yes, I'm willing to buy that thing at that price from you, and the other party is willing to sell that thing at that price at that future time, there's no other money exchange today. There's no value. There's no initial cost to enter. So we just sign a piece of paper. We enter into this agreement, and then at the maturity date, the transaction will take place at that price. But initially, there's no money exchange, and there is no cost to these things. They are worth zero. That paper is worth zero when it's being agreed upon. Now, something to be careful about is, and there are some funny episodes in the past about this, depending on what the underlying is. And on the next slide, we're going to see a bunch of different underlyings for futures contracts that are commonly traded. Some of those underlying, like for example, oil, will actually require physical delivery of the underlying asset at the maturity date, right? So you need to be ready to take delivery of thousands and thousands of barrels of oil, crude oil, when the maturity date comes. And some others will be settled by cash. So it's not going to matter. You're not going to have to take actual delivery of the underlying. But when the maturity date comes, we're going to look at what these things are trading at, and then we're going to just settle by cash without actually having to transact using the underlying asset. So when somebody enters into these forwards and futures contracts, it's very important to understand what happens at maturity date, whether we have to exchange the underlying asset or whether we can settle by cash. Okay. So common futures contracts types, if you look at some exchanges, for example, ICE, Intercontinental Exchange, is a big exchange that deals with a lot of futures. CME is another very important exchange. So if you go to their websites, you can see a lot of information. But some of the more common types of futures are those written on commodities. So the underlying is some type of a commodity, and this can be agricultural, like cocoa, coffee, cotton, sugar, juice, orange juice, especially frozen orange juice is a popular one, different grains, different types of livestock. So a lot of these are things that are used as raw material, right, on important industrial operations. So it is going to be important for different parties they will want to fix the price at some point in the future when they will actually need the raw material. So this will be a way for them to make sure their costs do not go out of hand, or they are able to sort of they're able to make sure they know exactly how much they're going to have to pay or how much they're going to get for the product, this important product, at some point in the future. Energy is another important one: coal, oil, electricity, natural gas. Metals, iron, gold, silver, very important also. And then there are some financial futures when the underlying is finance related or some sort of a financial instrument or security. Foreign exchange futures are very important, very common. So instead of, for example, me being kind of like Apple, for example, transacting in, say, yen, instead of converting their cash from dollar to yen or from yen to dollar at the spot price today, if they know they will have a lot of yen coming in at some point in the future, then they can enter into a futures contract and set an exchange rate that may be different from the current exchange rate, but sometime down the future, one day will actually get yens on their hand, and they know exactly to how many dollars they can convert it. So they are basically preventing taking on currency exchange risk. There's a lot of uncertainty with that, but with a futures contract, you can get rid of that. Okay. Similar thing, interest rates. Interest rates fluctuate a lot, but you can fix an interest rate at some point in the future using futures contracts. Credit default swaps. I'm not going to get into the details, but if you read or watched Big Short, some of the institutional investors there were actually engaging in or buying credit default swaps that would benefit from a decline in the credit quality of the mortgage market, housing market in the US. So there are futures contracts that written on the credit quality of certain packages of bonds. So that's a credit future. Equity derivatives. So you can enter into a futures contract written on the level of, say, the S&P 500 index or the Dow Jones index or the NASDAQ index. So we can engage in a transaction in the future that I sell you a package of S&P 500 at a certain price that may be different from where the S&P 500 is trading today. Okay, digital assets. There are now futures on Bitcoin, for example, which was a pretty important development in cryptocurrency markets at the time, not too long ago. And then there are some other hard to classify stuff like freight, which is shipping rates, right? So if you're a company that's engaging in a lot of international trade, you may be worried about if the shipping rates will go to very expensive, and that's going to hurt your business. For example, maybe demand will increase a lot, or fuel costs will increase a lot. Maybe there won't be enough ships at the time available. So you want to maybe get rid of that uncertainty. You can engage in a futures contract that will set the shipping rates at some point in the future. And there are some environmental futures contracts as well, based on amount of emissions, based on amount of carbon allowance. So this is going to be a growing market as green energy becomes more and more important. So there are lots of different underlying assets, okay, in these futures contracts. So let's see an example. A very important commodity is jet fuel. So this is, for example, very important for airlines and refineries. So there's a lot of uncertainty. Jet fuel spot price, cash price, which is the price at which we could transact today, it fluctuates a lot based on supply and demand, right? So for an airline that needs to set ticket prices today for travel, for trips months and months down the road, this is a big risk, right? So they are selling tickets today. What if jet fuel prices explode, right? Then they are going to be flying these planes where they will be losing lots of money, but because they sold the tickets, they're unable to cancel it. So they will burn in cash, basically. So one way to get around that is to get into a futures contract with, say, a supplier of jet fuel, a refinery, where both sides will be happy to hedge that uncertainty by locking in a price at some point in the future. So now the airline can easily sell tickets knowing that they've covered that uncertainty. They locked in the price, so they know what they need to charge the passengers. And the refinery is also know that they know the price at which they will be able to sell their product. So both sides are pleased. Okay, so for example, jet fuel spot price nowadays is $1.189 per gallon. So if we wanted to transact today, if I needed to buy 1,000 gallons of jet fuel, that's how much I would have to pay. But an airline, they know they will need jet fuel, maybe not now, but they will need it as in the future, maybe months or even years ahead of in the future. So they can enter into a long forward contract. So long is to buy, right? But to buy 42,000 gallons of jet fuel from a refinery, the refinery is the short position. They are selling at, say, 1.381 instead of the current cash price or spot price of 1.189. So they agreed at 1.381, and the delivery will be made in October 2023. Okay, so there's no exchange of money today. What's going to happen is in October 2023, the refinery will deliver and the airline will have to take delivery at a certain place of 42,000 gallons of jet fuel at that specific price of 1.381. Okay, so now you may wonder, well, why 1.381? It's much more expensive than the price today. Why would say United Airlines or a very well-known airline that does a lot of this is Southwest, hedges a lot of their fuel price risk by using these derivatives contracts, futures contracts. So why are they doing it if it's more expensive? The price will be more expensive down the future. What if oil prices go down? Or why not buy today and then store it? And the answer is, with a lot of these commodities, this will be the problem. Storing this stuff is very expensive, especially oil, gas, energy, and perishables, even more so, right? So it is going to be costly to store this stuff safely and in a way that preserves its quality for a long period of time. So if I was Southwest, I could buy jet fuel at 1.189, great, but it will actually cost me a lot to store this stuff until October 2023. Okay, so I am going to be willing to accept a higher price in the future, so I don't have to face the costs, what are known as carry costs, of carrying this commodity for such a long time in a costly way. Okay, so both sides will be pleased with this transaction. Now, as we did with options, an important thing to do with forward and futures contracts is to look at the payoff. So you engage in this transaction, what's your future payoff when the maturity date comes? Will you have been better off as a result of this contract, as a result of this deal, or worse off? So the payoffs will be different from options, mainly because here it's a contract that needs to be honored, right? And with options, there was an option, but not an obligation. So the shape will be different. But we still have these two important terms. K now is not strike price, but it's the forward or futures price that we agreed on. For example, the price of jet fuel in October 2023. And S, capital S, instead of stock price, it is going to be the price of the underlying asset. For example, jet fuel, which we call the spot price. So at that time, when the maturity date comes, we agreed on that forward futures price. That's what we're going to have to transact on. But we can also see what is the price of jet fuel at that exact same date. Okay, so the difference between the spot price and the forward futures price will determine the payoff, whether it's positive or negative. So what's going to happen is, so there are two sides to this. There are mirror images. One is the long position, so the party that agrees to buy the underlying. So for example, airline in the jet fuel example, what's going to happen is, so if they agreed on 1.3 something, right, are they better off if the underlying spot price is greater or smaller than the forward futures price? And the answer is they are going to be better off if they are able to agree on to buy the underlying at a price that's less than what would they have had to pay if they had to buy it in the spot price, right? So the x-axis is the spot price, so the jet fuel price is fluctuating, and we have our forward futures price. If the spot price is greater, goes above, then airline will have made a very good decision by locking in a smaller price, a lower price. Okay, so their payoff will increase. Airlines' payoff increases the higher the price of the underlying jet fuel in the spot market compared to the futures price. But they will regret it if the spot price is lower, and they would have actually have been better off not entering into the contract. Right? So we have this straight line, not asymmetric, not kinked like we had with the options, but a straight line that passes through the forward futures price, so K. And the greater the spot price, the underlying at maturity date, the better the long position, the buyer of the underlying is. And the lower the spot price, the worse off the long position is. Okay, so as a formula, payoff to the long position simply will be S, the spot price, minus K, the forward futures price. The greater that difference, the better off the long position is as a result of the forward or futures contract. Short position is mirror image because they are the other side of this contract, right? It's a zero-sum game. If the airline is better off and happy and they had a positive payoff, the refinery will be worse off. It's the negative of that, right? So that's what's going to happen, right? We're going to have the refinery being unhappy, negative payoff, if the underlying spot is very expensive. So without the contract, they would have been able to sell the jet fuel at a much higher price. And they will be much better off if the underlying is much cheaper than the forward. So they're able to sell it to the airline at a much higher price than they would have been able to at the spot price. Okay. And formula wise, this payoff to short position will be just, again, the mirror image. Not S minus K, but negative of that, K minus S is going to be payoff to the short position.